Let's keep moving further into the accounting cycle, where we will now focus on what happens at the end of the period. This is a critical part of the process, where we take what's on the books and apply some finishing touches so that they best reflect economic reality before we hand investors a set of financial statements. And we do this through adjusting entries. We'll shortly break down the what and the why behind these. First, a quick refresher on where we are in the accounting cycle. During the period, we did steps 1 through 4, gathering source documents, analyzing transactions, recording journal entries, and posting them to the ledger. Now, our focus is at the end of the period. Step 5 starts by preparing an unadjusted trial balance, and step 6 is where we make adjusting entries. After we record those adjustments and post them, we get our adjusted trial balance in step 7. And if we're at the end of a fiscal quarter or have some other need to prepare financial statements before year end, we would do so at this point, step 8. Then the end of the year stuff, steps 9 and 10 comes later when we close temporary accounts to retained earnings and prepare a post-closing trial balance. Let's start with the basics. What are adjusting entries? They are end-of-period journal entries made to update account balances before we prepare financial statements. So again, before we hand anyone an income statement or balance sheet, we go back through the books and make sure every account best reflects the underlying economics of our financial position and performance during the period. We do so based on the rules prescribed by US GAAP. And why do we bother doing this? We make adjusting entries to help us conform to the accrual basis of accounting. So let's define what we mean here by that accrual basis. It is the concept of recognizing revenues when they are earned and expenses when they are incurred, regardless of when cash changes hands. And that last part is key. Cash received from a sale and earned revenue may have wildly different timing. We'll be using cash to cover costs all the time, but we don't fixate on when cash trades hands to recognize expenses. It's when those costs were actually incurred. Under accrual accounting, we record activity when the economic event happens, not when the dollars flow. And this is the method required under US Generally Accepted Accounting Principles. Now, I've got 2 questions worth sitting on. Number 1, are there alternative methods? You bet. If you're a small mom and pop retailer with fairly simple transactions to record, you might be perfectly fine with, and maybe you even prefer using what's known as the cash basis of accounting, where you only ever record realized transactions. And then take other entities like state and local governments and not-for-profits. Those organizations have different objectives. They're speaking to different audience, so their accounting framework is going to look a little bit different than the full-blown accrual basis. And that's okay. But if we are trying to provide our investors and creditors with the best decision-useful information for their investing decisions, we are going to rely on accruals. So then, why is the accrual method the preferable approach here? We're going to have the entire rest of the course to explore the answer to that question. But for now, let me offer a few insights. Number 1, it tends to exhibit smaller variance when we report the results of operations. Empirically, I can show that we have more smooth and even recognition of revenues and expenses. And that's something that helps investors. They don't want to see earnings numbers bouncing all over the place. A smooth earnings path is helpful for forecasting. Number 2, it supports the matching principle, which states that we should do our best to match a company's expenses to the periods in which they help generate revenues. It helps to present a complete picture of the profits and losses for a given period because we've tried to match revenues to their relevant costs. Then, number 3, the accrual basis requires the recording of all transactions, even non-cash transactions, including sales and purchases on credit. Many large, important business activities can occur without cash ever trading hands, and the accrual method requires a company to give a full view of the operating activities of a business, even if cash has not yet or never will be exchanged. So, like I said, this is an important theme that we will keep revisiting throughout the course. But for now, I can objectively make the claim that because of accruals, Accounting metrics like net income are the best summary measures of performance. Now, I want to make a quick housekeeping point about timing. A calendar year is the 12-month period from January 1st to December 31st, the thing that you are familiar with if you look at your own calendar. Whereas a fiscal year is any 12-month period that a company uses for reporting. Most companies, roughly 2/3 to 3/4 of public companies at least, choose a 12/31 fiscal year because it lines up with the calendar year and tax filing. But I'd like you to consider, why might other companies or organizations choose something different? Take retailers like Walmart, Target, and Best Buy. They all select January 31st as their fiscal year end. And why is that? Well, it's probably because retailers have their highest sales in November and December due to the holiday shopping season. Ending the fiscal year in January allows them to include all holiday sales, and perhaps more importantly, the related returns in one period, which gives a complete, objective picture of their annual performance. Now let's take a university like UVU, where our fiscal year ends on June 30th. This tracks with the academic year and makes budgeting and reporting easier, as revenues from tuitions and grants and expenses, where a lot of that is faculty contracts, they line up with the timing of classes and academic activities. Now, all of this to say, while most companies report with a 12/31 year end, they have the flexibility to choose a fiscal year that best aligns with their objectives. Now, for this class, unless you are explicitly told otherwise, and I have no reason to expect that you will, you should always assume a 12/31 fiscal year end. That's really going to help simplify things, so let's plan on that going forward. Adjusting entries fall into three big categories. The first is deferrals. A deferral happens when cash changes hands before the revenue is earned or the expense is incurred. Classic examples on the expense side would be prepaid expenses, like prepaid rent or insurance, where you paid upfront and the benefit will get used up over time. On the revenue side, we have deferred or unearned revenue, where a customer paid you upfront before you delivered the goods or services. If the seller has not yet satisfied their performance obligation, we're going to defer the recognition of revenue until they've actually earned it, despite the fact that they've already received the cash from the sale. The second category is accruals. Sometimes we conflate all of these categories into just the singular term, accruals, but if we want to be semantically precise, we would recognize that an accrual is the opposite of a deferral. Again, the fundamental premise of accruals is that revenue is recognized when it's earned, or an expense when it's incurred, even if that's before any cash changes hands. So with deferrals, the cash transaction happens first, and we defer recognition until later. With accruals, the exchange of cash is going to happen later, but we go ahead and record an adjusting entry today to reflect those legitimate accruals. This could refer to sales and account, where your customer hasn't paid you yet, but you still record accounts receivable and recognize sales revenue. Another important example here is accrued liabilities, which can refer to a lot of things, like salaries that have been earned by employees but not yet paid, or other costs, like utilities, interest, and taxes that are racking up, we just haven't paid them yet. The third category involves the use of estimates. These are adjusting entries where we have to make a reasoned judgment about an amount that isn't precisely known. You'll keep learning about various estimates that accountants make, but two that you should already be familiar with include depreciation expense, which is the big one, where we estimate the useful life of a long-lived asset and its salvage value, and then allocate the cost. And then another one includes bad debt expense, where we estimate how much of our receivables won't be collected. We'll work through the actual journal entries for each category during lecture, but for now, just remember these three buckets: deferrals, accruals, and estimates.